Budget 2010 brought to you by Harith Fund Managers.
Well, any budget is always going to be assessed in light of the expectations before that news was released. And in that sense, this was about as favourable a budget as could have been hoped for. Let's not forget the market concerns ahead of this budget, that there might be some revision to either the inflation targeting mandate of the Reserve Bank or a change to the inflation target itself, that there were widespread rumours about the possibility of South Africa doing a Brazil and the imposition of a Tobin tax of sorts, a tax on inflows coming into the country, and of course concerns in the background that the budget deficit, previously forecast by the Treasury at 7.6% of GDP for the current fiscal year, would be even wider than that, with the market consensus anywhere between 7.8% to 8%. On all three counts, there has been good news for investors, good news for the markets. No change to the inflation targeting mandate of the Reserve Bank, a deficit for this year that has in fact been brought down by the latest estimates. Officially, that's expected to come in at 7.3% of GDP. And of course, on that issue of possible imposition of a Tobin tax, what we've actually seen is further important liberalization of South Africa's exchange controls and its foreign exchange regime.
Let's talk about that issue a little bit, because the status of the rand has been a major talking point for South African exporters. The call and the pressure on the minister was weaken the rand to boost our export sector, to boost local investment and jobs. For those of you looking in from the outside, the view is leave the South African rand to the devices of the markets. The minute the Treasury starts to tamper with the rand, it might prompt portfolio outflows from the economy. So no action on the rand, a further relaxation of exchange controls, but other challenges to the economy that still make investors a little bit concerned. Could we see other measures to try to stabilize the rand from its volatility without necessarily going the very extreme routes that have been called for?
Well, it's very difficult to see what can be done. And part of that difficulty stems from the fact that a country's economic circumstances will always be changing. On the one hand, South Africa is currently emerging from a recession. It looks as though the externally focused sectors of the economy are going to be doing all of the heavy lifting in terms of that emergence from the downturn, and that has implications for exchange rate policy. On the other, we are still looking at a sizable public sector borrowing requirement over time, and that is something that the South African authorities have looked at very carefully. What we have seen, in our opinion, is a great balancing act, not looking too much at the pressures that may be coming through from some quarters to put in place certain policies, but looking really at the bigger picture, the challenges facing South Africa and the best strategic way forward. We think markets will react positively, have already reacted positively, but will reward South Africa for the budget that has been seen.
Okay, we've seen the inflation target being kept at its current 3 to 6% range, but the inflationary picture for South Africa, Razia, a bit disconcerting, because everybody's awaiting NERSA's decision on Eskom tariff hikes to be made next week. Those looking forward say that the inflationary outlook for South Africa going forward isn't particularly positive, and we know that if inflation ticks upwards, it has a direct consequence for the rand, which has a direct consequence for the attractiveness of bond markets. How closely are you watching that story?
Well, the inflation picture is, of course, all important, but that too is going to be a function of how the economy is performing. We know that electricity prices make a very small direct contribution to the inflation basket. So it's really the tendency to see that secondary impact as a result of sizable electricity price increases that needs to be watched. It's arguable, given a weak economic backdrop, or an economic backdrop where the South African economy isn't performing to potential potential that you might see more of a hit to growth as a result of those price increases, rather than price expectations being raised across the board. So that secondary impact does depend, all importantly, on the wider growth environment. Yes, it's true that South Africa does need to see some adjustment to electricity prices. This is something that has largely been priced in by the market already. What we look to see, and what's very important, is that we're still seeing a strong emphasis on price stability going forward, no change to the Reserve Bank's mandate, and that should create a certain degree of trust amongst all stakeholders, whether investors looking at this closely, whether other participants in the South African economy, that the authorities are going to be doing everything that needs to be done to ensure price stability. That has an important effect in keeping inflation down over the longer term.